Hello, my name is Goncalo. I'm the co-founder and CEO of SyndicateRoom. In this short video, I'm going to try to explain why risk and reward are usually seen as the higher the risk, higher the potential reward, but it's not necessarily always like that. So if you imagine in a simple matrix where to the right you have risk and you have the risk increasing, and to the top you have the return, the financial return, and financial return increasing to the top. Now, typically you have a line here, in a very simplistic terms, whereby every time, if you move further up this way, the greater the risk that you're running with your own money, the greater the potential return that you'd be expecting from your investment. Now, in very simplistic terms, if you imagine that sort of savings account sit here, that means that very low risk, but much lower return. And then as you move up the scale, you probably move up the scale to where equity crowdfunding sits, which is higher risk than normal, potential for higher returns than a savings account. And this is really where equity crowdfunding sits. Now, there are two models in equity crowdfunding. One is company-led, the other one is investor-led. Company-led means that the company sets its own terms and puts out to the crowd for the crowd to decide to invest. Now, the downsides with a company-led is that there's a lack of detailed due diligence, which is typically said as DD, and there's no negotiation of the value of the investment. Whereas investor-led, that means that there are business angels that are kicking the tires, are checking the company, are doing the due diligence before they invest their own money, and they negotiate the valuation of the business before they invest their own money. Now, if you imagine that equity crowdfunding is here and this is the investor-led model, what you have when compared to the company-led model is a lack of due diligence. That means that it increases the risk due to the lack of due diligence. But also at the same time, because you're not getting a negotiation on the price of the shares, that means your potential return further down the line is also reduced. Now, this means that you're moving completely the wrong way on this set of scales to this point here, where you get a greater risk and a potential lower return than with an investor-led model. As a side note, investors that are very, very sophisticated, all they're looking is to move to this side of the line, where they have lower risks and higher potential returns. And as you can see, with company-led equity crowdfunding platforms, you are moving the opposite way to what sophisticated investors are moving in their portfolios. I hope this short video helped you understanding a little bit about how risk and reward relate to each other and how they should be considered in your investment portfolio. And I hope that you will enjoy other videos that we have in this series. Thank you very much.